Hello everyone. So this is the next video in the series about cryptocurrency investment. I've been making a few videos about explaining or simplifying cryptocurrency investment for people who've never done trading before, who've never understood what cryptocurrency is. And in that series, this week is a bit important because the prices of crypto are dropping rapidly this week. Some of the cryptos are probably down like 25-30% in value. Like Uniswap is probably like down almost 60% in value. There are a few cryptos that has run really badly this week, and it's like a bloodbath. And there's also talk in the town about cryptos being banned, crypto trading being banned in US and UK, and there's an FCA ban that's being talked about, Financial Conduct Authority of UK banning crypto. So there's a lot of talk about it. So today we're going to be looking at why are cryptos going down this week, what are some of the reasons, and also the news about crypto ban. So let's start with the crypto ban. There is an FCA ban on cryptos, but it is not for crypto trading. It is for crypto trading, crypto derivatives trading. What is the difference between crypto trading and derivatives trading? So derivatives are basically a different form of trading on a commodity. So in a normal trading process, you buy a commodity, you sell a commodity for either profit or a loss. Derivatives are basically where you don't actually buy the commodity or sell the commodity in the first place, but you're betting on the price of the commodity to either go up or go down, and you're trying to make a profit out of that. So how is there an analogy? Like let's take a cricket match for example, right? In IPL, the owners buy a player, they invest money in it, and then when the team does well, they get profit out of it, and there are sponsors who actually pay into the team, and then as and when they perform well, there is a vested interest in getting profit out of it. When the team wins, they get a prize money. Without being connected to the team at all, there is a sports betting that happens, whether or not which team is going to win. Like if Chennai is playing Kolkata today, will Chennai win or will Kolkata win? They bet against it or bet for it, and then they are not connected to the IPL ecosystem at all, but they're basically trying to make money out of it. This is kind of a good analogy to derivatives as well. Then why did the government even allow derivatives in the first place? Derivatives are not just for crypto alone. Derivatives, they're for every commodity. They're for shares, they're for commodities, they're for crypto. There are some good things about derivatives as well. So we'll explain what is a derivative before we actually go into a commodity, before we go into the crypto ban for derivatives and how it affected the prices of cryptos, and what does the ban mean to cryptos in the real sense. One thing before we go into it, right? So the fundamental question is, if they are trying to make a profit and we are also trying to make a profit by buying and selling a commodity, how is it different? Why is it different? Ethically, the concept is different. Like if we are actually say buying a commodity and selling a commodity, or we are investing in a share, then it's like take a vendor who's selling onions in the shop, and when you're buying a share, you're basically giving him money to conduct his business, so he can buy equipment for it, he can buy the onions, he can actually do the job because of the money that you're investing in him, and then the profits that he gets, if he gets more profits, then you're getting more profits as well. You're basically helping the ecosystem. But in a derivative concept, somebody who's standing in the road, not contributing to this ecosystem, not helping this onion vendor, they're basically betting whether the price of the onion is going to go up or come down. So that's, in a way, it is a danger to the ecosystem, because they're actually betting against the price coming down, or betting for the price coming down, and the onion vendor may not get any profits at all because of that. So let's start with the typical definition of derivatives, and let's go into a few examples. So if you take the technical definition of derivative, it says that it's a contract between two parties based on an underlying financial asset, and they're speculating on the price movements or future price movements of the asset, and they're trying to book a profit. And if you actually look at the technical details of it, it talks about different kinds of derivatives like futures, options, swaps, hedging, price predictions, and it's a really difficult terminologies to understand. So what I'm going to do is I'm going to basically take two good examples of derivatives, which then make you understand why they exist in the first place. So let's take an example where there is an airline company like Jet Airways or somebody who's like basically trying to fix their total cost of the year, control the total cost of the year. So jet fuel is something that is going to go up and down every month. And what they're doing is basically they know how much quantity of jet fuel they're using every month. So let's say they're using 10 liters per month, right? And the price in the beginning of the year is like 1,000 rupees per liter. And what they're doing is they're going to a petrol vendor, they're going to a petroleum provider and saying that, look, let's fix up an agreement where I will buy 10 liters of petrol from you the whole of this year. Every month I'll buy 10 liters, but let's fix the price at 1,000 rupees. Let's hedge it. It's called hedging process. And the petrol vendor, let's say they agree, right? So irrespective of whether the price goes up or goes down, the airline company will pay the petrol vendor only 1,000 rupees. Now, what is the benefit, right? So, for example, if it goes up in February, they're still paying 1,000 rupees per liter, and which means that they're paying less. And later on in the year, when it goes to 600 or 500 rupees, they're still paying 1,000 rupees. They're paying more than the market rate. But eventually, if you look at it, let's say the average price remained higher in terms of the price that they hedged. So they spent like 120,000 rupees, 1,20,000 rupees. And had they not hedged it, they would have spent 134,000 rupees, which means that they have saved 14,000 rupees from an airline perspective. Is it a loss for the petrol vendor? No, they had an actual pipeline of sales and they had a commitment from a buyer who was basically willing to buy 10 liters every month, which means that they had a revenue that they could book in their systems as well. So the vendor also kind of profited from it because, it's not an ultimate loss from their perspective, but they could have made more profits had they sold it at a market rate. So this is a hedging where it's good for the airline. Now, the other scenario is that the prices could have come down and the prices could have stayed low consistently through the year. But still, from an airline perspective, they control their cost. They decided that their cost is going to be 120,000 rupees or 1,20,000 rupees, and they didn't exceed their budget by even 1 rupee, and that's the advantage that they have. The petrol vendor, on the other hand, they made a additional profit of 11,000. Even on the 109,000, they mean on the 1,09,000, they would have made profits, but they made additional profit of 11,000. So the hedging basically gives an advantage for both the buyer and the seller here. It's kind of, it's an advantage for them to agree on a fixed price for the whole year, and it stabilizes the market for both of them and controls the expenses for one, controls the revenue for the other. So that's kind of a good thing from a hedging perspective. Now, there are some share options that are given to the employees. In general, they're given as a value, they're given as money to the employees. Let's assume a company doesn't have money, right? But they want to give bonus to employees. So the company's share price is, let's say, 10 rupees. They give an option to purchase 500 shares to the employee, which is worth a value of 5,000 rupees. But the employee has to pay to purchase it. Now, what's the benefit to the employee? Because he really has to pay money to buy it. And the company is actually not spending any money because they're not giving it for free as well. The catch is that the employee has 1 year before which they can actually buy these shares for this price. Let's assume within the 1 year period or after the 1 year period, its share price is going up to 30 rupees at that point of time. Now the employee can exercise his option and he can buy the 500 shares at that point of time, and he only pays 5,000 rupees because it's at 10 rupees for him. So he pays 5,000 rupees, but the share value today is 15,000 rupees, which means that he immediately made a profit of 10,000 rupees, and he doesn't have to buy it. There is no obligation for him to buy it. It's only giving him an option to buy. This is called as options. This is a concept of futures, and the advantages are that the company didn't pay any money and they wanted to give some incentive to the employee, but all they did was they gave an options, which meant the employee also had a vested interest for the company's share to grow. So they're basically kind of working hand in hand, the employee and the company, to make sure that the share price goes up, because then it's advantageous for everyone in that scenario. So this is also a concept of derivative, but it is actually a good derivative. So there are a lot of good things about derivatives that exist in place, and that's why the concept of derivatives came into picture. So derivatives can be done, we saw how it can be done in petrol, we saw how it can be done in shares, it can be done in any commodities. Replace the petrol concept, right, with the airline and the petroleum provider. You could replace it with a roti maker, getting his wheat flour from a wheat flour merchant. And it's the same concept. Or you can make a biryani maker, getting his rice from a rice maker. So all commodities can be traded using derivatives, and they are getting traded using derivatives throughout the world. hedging is a very good concept, options are a very good concept. They are all existing because there is a necessity for them. So what's bad, right? And if there are so many good things about it, what is actually bad? The problem comes in cryptocurrency more because of the volatility of the price that is existing, and there is no real rationale behind why a crypto's price should go up or come down, like shares or like commodities. And commodities are based on demand, supply, and there are so many other things that determine the commodity prices, not just the trading alone. But from a crypto perspective, we talked about it in our earlier videos, how volatile the prices can be, and how quickly the prices can go up and come down. So let's take an example where there is a crypto called ABCD, right? And the price of the crypto on 1st Jan 2020 is, let's say, 1,000 rupees. And a buyer wants to basically buy the crypto, but they don't want to spend the money. So they go and purchase options from the exchange. This is an exchange that is holding crypto, and they are giving an option to buy options. So they're buying options saying that, okay, 100 quantity of crypto, you can buy it anytime during the 1 month period. And you can buy it at the 1,000 rupees that it is right now, which means that the value is 100,000 rupees that they're actually hedging for, they're actually giving an option for. And what they say is basically that you pay per crypto, you pay 100 rupees. So instead of paying 1,000 rupees, you pay 100 rupees per crypto to buy these options, which means for the 1 lakh value of crypto, he pays 10,000 rupees for options, which means within that 1 month period, at any point of time, he can actually exercise his option and he can buy this crypto. Now, assume that in scenario 1, it's 1,300 rupees on 20th of January, which means it's gone up, right? So he can exercise his options. He goes in and he pays 100,000 rupees, and he buys the crypto. The value of the crypto, because 1,300 rupees at 100 crypto, is 1,30,000 rupees, which means he spent 10,000 rupees for buying the options originally. He spent 100,000 rupees for buying the crypto today. So his total profit is 20,000 rupees because he can sell it at 130,000 rupees. Now he's made a profit. Now assume a scenario where the price never goes above 1,000 rupees, right? It stays in 1,000 rupees. So let's say on 31st January, it's 700 rupees. If he actually goes and exercises his option, buys it, then he has to spend 100,000 rupees because he can't buy it at 70,000 rupees. If he's exercising the option, then he'll buy it at 100,000 rupees. Which means that he'll make a total loss of nearly 40,000 rupees because one, he's lost out on the crypto, another is also paid 10,000 rupees on the options price, right? So instead, what he'll do is he'll cut down his losses and he'll just walk away saying that I'll not buy any crypto. It's fine. I got my options. I'm not going to exercise my options. These options goes away. So it's an unused option. So the unused option is basically giving the exchange a profit of 10,000 rupees. So the exchange never sold any crypto. Nobody actually bought any crypto. No crypto was being actually physically sold or bought. But the exchange has made profit. And the buyer has lost out his 10,000 rupees money that he wanted to invest, or he invested already. So in the from an interest perspective, the exchange's best interest lies in the fact that the crypto price stays below 1,000 rupees for the entire month, depending on how many people have invested it. Now this is one person buying for 10,000 rupees, right? Let's assume there are 10,000 buyers who actually come and buy options like this. The exchange stands to gain nearly 10,000 crores or 10 million rupees basically without even selling one crypto, because 10,000 buyers each buying at 10,000 rupees, right? It's a huge amount of money. And if the exchange can maintain the price below 1,000 rupees somehow, working with whoever it is, then they are basically, without selling even one crypto, they are making a profit of nearly millions of rupees or crores of rupees. Now this is where the problem comes in, because of the money that is involved, because of the profit that the exchange gains by manipulating the price. There is a huge price manipulation that goes on, because the exchanges also hold our crypto. They are actually having our crypto. They can go and use our crypto to do techniques like shorting. Shorting is something where it's an intentional price manipulation where you can actually mass sell a crypto or mass sell a commodity and bring the price down, create a panic and bring the price down. So there are a lot of concepts like these where some are legal, some are not legal, where you can actually use these techniques to bring down the price of a commodity or bring down the price of a crypto in this place. And a lot of fraudulent practices take place because these stakes are very, very high. Like, I was talking about 10,000 people, but we are talking about millions of people who are buying options, who are buying these derivatives, which means the exchanges are getting more and more greedy, and it's becoming like sports betting, right? Where we talked about sports betting, where two people are betting on the outcome of a match, Chennai versus KKR, for example. And if a lot of people have invested on Chennai winning the match, then it is the interest of the sports betting body to make sure that Chennai doesn't win the match, and they are actually paying players and going to the extent of paying players to make sure that Chennai loses the match, so that they are getting more profit out of it. So whichever team has got more money invested on them by the people, they want the team to lose so that they can actually take the money. So that's what happens in crypto as well. If a lot of people have bought options expecting that the price will go up, they actually want the price to come down or remain lower. And this is what is being accused by the government bodies on the major exchanges. So the major exchanges like BitMEX, for example, was recently accused by the US government, where there's criminal charges being brought in on the owners of the exchange. And this is probably the first time something this severe has been taken. A lot of actions have been taken against crypto exchanges before, but this has gone to the extent where criminal charges and prison sentences are being talked about for the owners of BitMEX exchange. So that's why a lot of these exchanges, people keep asking me in comments as well, especially in the Tamil videos, about exchanges that are in India mostly, where are we okay to use these exchanges we are using. The reason I suggested Coinbase and WazirX is because they are practically the gold standard of crypto wallets and crypto exchanges. WazirX is owned by Binance, and they are like the number one in terms of the exchanges and wallets, and they have never been accused of any of these malpractices before, which is why I suggested using them in my episode 3. I even gave a demo of how to register with them and use them. So I don't have anything against the other exchanges or other wallets. It's just that I'm not comfortable using some of them. I haven't personally used them. So I'm suggesting what I'm personally using. That's why some of the other wallets are being mentioned. So obviously the exchanges being investigated, what it means is that people have bought derivatives, people have put money into it. Now they can no longer trade, or whenever the ban comes into place. For example, FCA has put the ban. I think it's given like a couple of months to close out all the derivatives, but you can no longer trade the derivatives after that point of time. But that also means that the money has to come out immediately. So there's a lot of money being lost from the crypto market because of this, which eventually means that the value will come down. But all of this will lead to a market correction, because eventually when these derivatives are out of the crypto market, then it follows more standard norms in terms of the price going up or going down. The price manipulations will come down, which means that it's good for the industry on the longer run. The other thing is there was why the crypto price is dropping, right? So, and Trump has something to do with it. So a couple of months back, 2 or 3 months back, there was a stimulus check that was provided to all the American citizens, $1,200 for every American citizen. Because of the COVID-19, because of a lot of people having unemployment, a lot of people not able to work, a lot of people having problem with their income, $1,200 was provided as one of the largest stimulus checks or stimulus packages ever provided in the history of United States, or probably for any country for that matter. Nearly $2 trillion were provided to the American citizens. So $1,200 for every citizen. And this money was huge for a lot of people, and it meant bread and butter, or it basically meant the next meal for many people. But a lot of people were okay. I mean, they were not struggling for money, but this meant that they could actually take this money and invest it somewhere, which means that a lot of people decided to invest it in cryptocurrencies, and a huge influx of money came into crypto during that point of time. So a second stimulus check was expected around this time, and which meant that people were expecting another $1,200 from the US government, and which also meant that another influx of money that's going to come into the crypto industry or crypto market. And we talked about market capital and why new money is very important for these cryptos to go higher, right? Trump basically tweeted like a couple of days back saying that he's probably not going to give this second stimulus till the election is over, and this is a bit of politics that is going on with the second stimulus. That has also created panic, because one, new money is not going to come in, and two, people were expecting this stimulus check for their next meal, and now people may have to urgently sell their commodities, including cryptos, anybody who's invested in it, to get money out of it for managing their finances for a few days, right? So there's a lot of connection between the stimulus check and the crypto as well. And it's like a butterfly effect. One corner of the world, something happens, it affects the entire industry, and including crypto. Crypto is no exception for it. So everything is interrelated at this point of time. And hopefully, once all these derivatives problems are over, because everybody's portfolio is down, 30% to 40, nearly some of the cryptos are down like nearly 30% or more than 30% this week. So expectation is that when all of this stabilizes, it's going to come back to the normal scenarios, and hopefully things will turn better. So I hope this video was useful for you, because there's a lot of panic that is out there saying that cryptos are being banned, or people can't trade cryptos. The truth is, cryptos are not being banned. It's derivatives which are being banned, and you need to understand derivatives to understand why it is being banned and what does it mean to the crypto trading itself. So until next time, see you later. Thanks. Bye.